Hi, and welcome to the first part of the Becoming a Trader workshop series that is demystifying the craft of trading. That's what we're going to be covering today in this lesson. Super excited to jump into it. Now, it's that whole idea behind trading. It can be quite overwhelming. It can be quite confusing, especially if you've caught fragments of conversations from different traders, right? There's not just one type of trading. There's a variety of types of trading, and there's countless means of analysis to predict where its price is going to go next. But to boil it down, the essence of trading is predicting where price is going to go next and getting in and out at a favorable price, right? So that's what we're going to go through today, and it's going to be broken down to four major parts. And that is, firstly, what is a chart and how to actually read price action. So what are these, again, squiggly lines on the charts here? What do they actually represent, right? So we're going to cover that first. You're going to get an understanding of different time frames, the candlestick patterns, the Japanese candlestick patterns is what they're called. Basically, what does all that mean? Next, we're going to go through the basics of a trade. What is it? Like, it's not just buying low and selling high. That's more investing. It can be just buying low and selling high. But the three primary things is your entry price, your stop loss, and profit target. Without a stop loss, it's not a trade, it's just an investment or a speculation. Next, we're going to go through the different types of analysis. So you might have heard the terms technical analysis or fundamental analysis. You might be wondering what the heck they mean. What's better? What's worse? What should I do? Now, I am primarily a technical analysis trader. There's a sprinkle of fundamental analysis, but I'm going to go into the details as to why I've chose technical and why I personally much prefer technicals versus fundamentals. But at the end of this, you'll be able to decide what kind of trader you would prefer to be. What kind of analysis is it that you prefer? My personality, more towards technical analysis. And then finally, we're going to go through how exactly do you make money from a trade, right? Because it's not just as simple as buying $1,000 worth of Apple shares, it going up 10% and making $100 off that, right? That's not, it can be, but there's more investing, right? Trading is a bit different. How can you make money when the price goes down, right? You can't do that with investing, right? If you buy an Apple shares and they go down in value, well, you lose money, right? But as a trader, you can actually make money as the market goes down. So, we're going to dive into all of that. Those are the four parts. So let's jump into the first part, which is what is a chart and how to read price action. Let's begin with the candlestick, the Japanese candlestick. This is what this entire chart here is comprised of. Every one of these is contains data, right? And we can use that data and incorporate that into our trading. So what one of these represents, you can see some of them are green, some of them are red. You can change the color if you so prefer. You lay out your chart however you desire, but we've generally got green and red candles. Now, red candles are down candles, green candles are up candles. Now, we've got wicks. These are called wicks, as the skinny lines here below the candle, and then these are called bodies. So the chunky part is the body of the candle. So what does it actually represent? Well, we have a selection of time frames up here. 5 minute, 15 minute, 1 hour, 4 hour, daily, weekly, monthly. That's not what the entire data is on the screen. That is how much time is in each one of these candles. So if we have a look at let's just take one particular candle, any old candle. Let's go with this candle here, this big green one. So I've just deleted some of the data there. Red candle, red candle, red candle. This drives all the way down, driving price down, and now price has gone up here. Don't need to worry too much about the price on the side here, or even asset. This is just a forex pair here, but this is the same concept applies to crypto, to equities, to commodities, whatever it is that you desire to be trading. But having a look, so what makes it a green candle is where price opened and where price closed, right? So the open price being a green candle, we know that the price opened here and it closed here. So we could even go ahead and write that on there. Call that open, right? And over here, this here was close. And we can see those little tags there. So that's where it opened, that's where it closed, within that 4 hour window. Now over here, this was the high of the candle, right? So the high during this 4-hour period, price ran up here all the way to this level and then closed down here. Now it might have ran up, pulled back, ran up, kept like chopping its way around here within the 4 hours. Obviously it wasn't probably just a clean run up and then pull back, right? This is what it's called. Run is with the trend, right? We'll explain more of this later. And then a pullback is yeah, basically against the trend. So overall, this would be a run. This would be a pullback, but without digressing too far, we'll get to that later. So that's the open price, that's the close price, and that was the high. Now this didn't really have a low. The open seemed to be the low, so it seems like when price opened, it just shot up. Now something like a candle like this one here, we can see price opened at the top. So because this is a red candle, it's the inverse of what we just covered in the green candle. Because it's red, it means, let's look at this big one first, is this here was the wick was the high during that 4-hour window, and this was the low, the wick down here. But it opened here and it closed here. So for it to form a red candle, the open price is at the top and the close price is below. So the close was lower than the open. Now if the close is higher than the open, that's when it's a green candle. Cool, makes sense. And then this is the peak and the bottom of the wick. So this one here, this is what we call a doji candle. You'll learn all the terminology as we work through. But a doji is where price basically opened and closed and didn't really go anywhere. It just opened and closed at the same price, right? And these all give us little bits of data, right? So generally, and they all have their own kind of general rules. So we can see with a big, what we call big red candle, generally big green candle. Big green candle usually is followed by a green candle. Right, big red candle is often followed by red candle, and so on and so forth. If we look back here, this is not a very nice price action, but for the most part, an up candle usually follows an up candle, and a red candle or a down candle generally follows a down candle. That's what we'd call our first confluence factor, right? We want to be trading with the trend more so than against the trend. So we want to be predicting, firstly, where do we think price is going to go next? What is the next candle going to be? And we look at that from a higher time frame. So in this case, we're at the 4-hour time frame, which I kind of consider a middle time frame. But we might be looking at like the daily time frame, which would one candle representing each day. And that gives us 24 hours, 24 1-hour candles or 6 4-hour candles within that candle, right? I don't want to get too confusing here. If we're day trading, that means that we're trading on those lower time frames, anything less than a 1 daily candle time frame. Make sense? So if we can predict that the next candle is going to be a big or a green candle, we're going to be looking at the lower time frames to catch those smaller, we call intraday moves. If the 4-hour is going to close higher, it's going to create that green candle, then the 1-hour and the 15-minute time frames are going to print quite a few green candles within that larger big green candle. Make sense? Likewise, if we're on looking at the daily or the weekly candle has got 5 candles within it. The daily has got it's got 5 daily candles within the 1 week, obviously because there's 5 trading days. That's specific to forex. There's 5 trading days. Markets are open 24 hours a day, 5 days a week. Crypto is 7 days a week. Equities are specific to which stock exchange you're trading, but they have business hours that they trade within, right? So that's what a candlestick is. So when we jump down, if we have a look, so this is the 4-hour. If we jump down to the 1-hour, we can see that there was 4 green candles within that 4-hour candle, right? Now there doesn't necessarily, they might not all need to be green, but it just means that combined between them, they ended up, there was more green than red. So going back to the 4-hour, so we can see a lot of this was just red. Just this is what we call a bearish run, right? So the bears, that's a quick bit of terminology there. Bulls and bears, or bullish and bearish, just means it looks like it's going to be going up as bullish. It means there's more buyers in the market than there is sellers. That's what drives price action, is buy, driving price up. There's more buyers than there is sellers. For it to be bearish or a downtrend, that means that there's more sellers in the market. That's the difference. If you've ever heard bullish and bearish, or if you've seen any photos of if you watch Billions and you see in the office, he's got a little brass statue of a bear and another brass statue of a bull, or you go down Wall Street, you see bulls and bears everywhere. That's what that means. It just means buyers and sellers. I don't know where the term originated from, but that's what bullish and bearish means. So jumping back down to the low time frame. So this is the 4 hour, as we just covered, that 4 hour candle. If we jump down to the 1 hour, we can see that price, the open price of the 4 hour. So we can see 1, 2, 3, 4 candles, right? Now, this was the beginning of the 4 hour candle right here. And we can see it didn't form any wick, right? There was no wick to the bottom. Now, price ran up in this 1 hour candle, opened here, ran down here at some stage, ran up to here, opened here, and it was doing this, and then it got all the way up to here, and then it eventually closed here, right? So it was because price closed there, that's what formed the wick of that 4 hour bullish candle there. So bullish candle, bearish candle, green, red. So there you have it. That's a chart. That's what it represents. It's probably its most basic, fundamental level, ground level. It's all just made up of what we'd call raw price action here. Now, of course, there are indicators, there are levels, there's support resistance, there's price action patterns, there's candles, there's a whole number of things that you can, and elements to trading that you can incorporate and layer over the top of these candlesticks. But really, it is all just raw price action, right? Somebody's designed a fancy indicator or something like that. That's just, the indicator is just based on this data here, right? So this is the ground level. This is what you need to, as a professional trader, this is what you need to learn to be able to read, is to read raw price action. Now, you see, the easiest way, the dead giveaway for a beginner or a novice trader, somebody who doesn't really know what they're doing, is when you look at their charts and they've got squiggly lines, they've got indicators galore, they've got crap all over their screen. And you're like, you're probably not a very experienced trader, right? I sometimes see screenshots come through from people who take trades or they need assistance. They're messaging in being like, you know, what can you see here? And I'm like, I can't see anything. You've got 20 indicators covering your entire screen with junk. That is not necessary. And that just goes to show that they are unable or incompetent, or I don't want to say incompetent, but they are not relying on their ability to be able to read raw price action, right? So this is, for the most part, this is what my charts look like most of the time, right? We don't need to overcomplicate it. We don't need to, we want to keep it simple. That is the most important thing. There are a few elements, a couple of indicators that I use, but we're going to cover them in the next workshop. So next thing that we're going to move on to is the basics of a trade. So what does a trade actually look like, and what are the elements to that, right? And this is a setup. So it's not just buying in and hoping that the price goes up. Again, that's investing. Trading, a little bit different. So let's jump back on the charts and I'll cover the basic elements of a trade. So having a look at the same currency pair, Aussie Kiwi, it's the same chart here on that 1 hour. We've just zoomed out a little bit. So we want to take a trade here. Now, the great thing about trading versus investing is, as I've said before, you can short the market. You can go long or short. Now, long and short is not it's not about the time or the duration that you're in the trade. It doesn't mean long means that you've been in it for months. Short means you're in and out quickly. Not at all. In trading terminology, long means going up and short means going down. Remember how we got bullish and bearish? Again, I didn't come up with this terminology, but bullish means that it is moving up. A long trade or a long position means that you are trading with the bulls, right? You're going up. It's all fancy terminology, isn't it? And then short is going down. Make sense? Makes sense. Back to the charts. We have what we call is a bearish trend. Why? Because price is kind of moving down. It's in the last X amount of candles, it's gone down. It's broken these lows here. So we're looking at often highs and lows. Basically, this looks pretty cool, right? We want to be trading with the trend, and we want to be buying or selling high and buying low. Makes sense, right? So you can sell before you buy, and that's just called going short. So price has been going down. It's run down. It's pulled back. This is a run because it's the longest kind of leg. If this was, let's go back. Here's an example. This here would overall be like a run and maybe a pullback, and then a run, pullback, and an uptrend. Right now, this is a downtrend because it's broken all lows here. Any lows here, it's broken it. So run, pullback. We've got a what we'd call deceleration. I'm flying through a lot of this because we're going to be covering this in future modules as well. But it's run, it's pulled back, and we can see it's formed this a doji style. It's I'd call this a high test doji candle. Why is it a high test doji? Remember, I covered it back here when I was on the 4-hour time frame, wasn't it? Like this guy looks like a doji. It just, the open and close price was almost identical, right? And then that's what makes it a doji. Now the high test is that it actually ran up, it formed a pretty high high. It tested this high, and then it drove price back down again. So what actually, interpreting or to read the story here, what happened is for price to go up, the bulls entered the market, buy. They're buying, everybody's buying here. Every time there's a new bid or a new order gets filled, buyers are driving the price up, kept driving the price up. And now what pushed price back down? The bears entered the market, right? The sellers who were in control of the market back here, sell. Yeah, there are a couple of buyers in here, but sell. This overall was a bearish trend because the bears controlled the market. There's like a war being waged between bulls and bears at all times in the market, right? Now, the bears won this run, they won this round, right? And now the bulls stepped in. At this point, this high test candle is a strong indication that the bears have now entered the market. Now the sellers say, okay, you've had your fun, bulls. You've got to this level. We're not going to let you push price any higher. And they actually see it as a good value point to continue their selling position. So the traders who entered all the way down here, who drove the price down, when they saw price slowing down here, we can see like all these doji candles, this is often an indication that price is going to turn around, right? Because it's a slowdown. We call this deceleration, where there's a combination or a run of these kind of sideways candles or indecision candles. See, this one here is what we call a long-legged doji. He's got a high and a low, unlike this one, high test, because he doesn't have much of a low. This is just straight up and then back down. This one here didn't know if he wanted to go up, didn't want to know if he went down, up or down, just ended up opening and closing pretty much right at the same spot, meaning that there was an equilibrium of buyers and sellers in the market. Right. So again, when there's more sellers, price will go down. When there's more buyers, price will go up. When there's a battle or a balance between bulls and bears, price will just go sideways. And it did that multiple times here. So a good example of this is think of a tennis ball or a cricket ball or whatever it is that you're into, a softball if you're American, right? Is you take get a ball and you throw it up, right? When you throw it up, it will accelerate, it will reach top speed somewhere shortly after leaving your hand, and then against the power of gravity, of course, it'll slow down, it'll decelerate, it'll be going before reaching stationary at the top. It will be stationary for a microsecond, but just as it's approaching that point of not moving at all, it will start to decelerate. And then, of course, it'll accelerate to come back down and it'll reach full speed once it reaches your hand again. So that's the same thing that we see in charts, right? So jumping back onto the chart here, I mean, if we were just to flip this chart upside down, because it doesn't really matter, which direction it is, but we'll say that this is as the ball left your hand. I know it's a little bit confused, just bear with me because just pretend it's inverted, right? But it's leaving your hand, acceleration, full speed, starts slowing down, reaches equilibrium. This is like at the peak or the pinnacle of its journey, and then it starts accelerating, picking up again. Now, because the overall momentum, and this is why we like to not zoom in too close and we look at the big picture, we can see overall it's still heading down, right? This is just pulled back. This is a run and then a pullback. So, and then now it's decelerated again. We've got big top speed reached here in the middle with this bullish engulfing candle. Bullish engulfing means just a big boy, just bigger than the rest. Like these two are pretty obvious bearish engulfings. This one's probably also quite a bearish engulfing, and then it starts slowing down. So bullish and bearish engulfing. There we go. It's another little bit of terminology. There's not too much more. We've pretty much covered all of them now. There might be one or two, but if you're getting overwhelmed, maybe you could start taking notes of these, write them down, and get an understanding of what they are. Non-essential for needing to trade though. So as it runs up, deceleration. So deceleration, slowed down, smaller candle than the previous one, and now it's reached that point of equilibrium, right? It looks like the ball has come down, bounced. So let's say this was thrown at the ground hard, it's bounced, and now it's up here. Now the force of gravity has balanced it out. Where's the next candle going to go? It's probably going to go down, right? So this could be a great opportunity to take a short position. Now we only ever trade a strategy with fixed rules, right? There's a saying amongst professional traders is trade what you see, not what you think. So we need to basically stack together what's called confluence factors in line with a strategy that you've pre-planned, pre-written out. You've got a trading plan. If X happens, if X, Y, Z, then ABC. I'll enter the trade here with the stop loss here and a profit target here, and we'll manage using this method, right? We'll cover all that later. But for now, let's just consider that we saw a profitable strategy right here and we wanted to take this as an entry. This is how the entry would look, right? So we'll go ahead, let's say that we took the entry right here, right now. We're guessing that the price is going to go down. So we'd put that there. Now what this is here, this is like a position sizer, right? So there's a few other extra benefits. I'm just going to remove that out of the way for now. There's a few added things here. So we can see that this high, it bounced off here. So we can also expand further and say, why did price do this? Sure, it slowed down, but why did it slow down here? We can look back and see that this other level here, there's another little what we call resistance level, support or resistance, support if it's below, resistance at the top, run down, pull back, broke down. We've got a whole section. This is going to be, I think, is it module 2, module 3 of the workshop series that we're going to be covering the 6 core principles, right? So the 6 core trading principles, which is going to cover pretty much what we've covered. So I'm just really breezing over the support and resistance and price action and runs and trends and phases and things like that, right? But we will cover them, I promise. So for now, looking at this, you'd be taking a stop loss. So how you make money from trading, it's not about how long you're in the trade, or it's not about how long you're in the trade. It's not about how much the trade moves, which sounds counterintuitive. You think the more the trade moves, the more profit you're going to make, right? Not necessarily. It is all about the ratio, or what we call your reward risk ratio, right? And then that's how you position size. So we don't just go in with a $100,000 account and just say, oh, we're gonna buy 2,000 of this and 5,000 of this. That's not really how it works, right? The lot size is something that it's not really relevant, right, to trading. All that matters is the reward risk ratio. So this position here, if we were to take the entry right here, right at, we like this candle as it formed, and we said, look, let's go short here. We put our stop loss. Now there always has to be a stop loss. The ratio is the ratio between your profit target. So this here is profit target. Let's go ahead and update these guys. So this here is profit target. This one here is, let's go make it a bit bigger. We'll go entry price. That is right there in the middle. And then this one here is stop loss. Now we must always have a stop loss. If we don't have a stop loss, well, now that's really gambling, and it's very dangerous. You don't know, always trade with the stop loss, and you can't position size correctly without having a stop loss. Let me explain why. The distance between here and here, this red box here needs to represent 1% of your trading account, right? 1% is all we're ever risking on any one trade. So if you have a $1,000 account, you're only risking $10. $10 per trade and never anything more than that, right? If you got 100,000, then you're trading $1,000, or you're risking $1,000, right? The lot size, the position size doesn't matter. It's only ever that much. Now, getting more microscopic, if you get into scalping, right, and you're going down to these, scalping is like trading micro time frames. You're trading the 1 minute, the 2 minute, the 5 minute. You can still bank a, you can still risk $1,000 on a much smaller stop loss. It doesn't matter how many pips is what they call it. Pips is the measurement of the size of the stop loss. Like you can risk $1,000 on a stop loss of 100 pips, of 50 pips, of 20 pips, of 10 pips. It doesn't matter. It's just a 10 pip stop loss versus a 100 pip stop loss. The lot size, so the actual position size, is just 10x. It's 10 times the position size on a 10 pip stop than what it is on a 100 pip stop. Now, due to leverage and liquidity, your leverage is virtually infinite. You could put it, you could make your stop loss pretty much the same. You could put your entire account on the distance of one stop loss, which you don't want to do, right? Certainly don't want to do that. So let's say like Apple shares, for the most part, some countries have different regulations, but for the most part, internationally, if you could buy Apple shares and you could say that it's going to, it might only go up 1 or 2 cents, or sorry, $1 or $2, and you might be able to blow a $100,000 account just by it going up 1 or 2%, right? How do you do that? Or we're going down 1 or 2%. That's just due to your position sizing, right? So we're never risking more than 1% per trade. And leverage, if you've heard of leverage, is basically just magnification, right? Let's cover that in a moment. We'll get back to that one, but about the different markets. A lot of people love in crypto at the moment. Some people prefer the stock market. Some people prefer forex or commodities. Really, it doesn't matter, right? They're all, a chart is a chart. If you want to trade bananas, all good. If you want to trade something else, all good, provided you're a technical trader. Fundamentals are a little bit different, which we're going to cover next. So anyway, this is our chart. This is our setup that we're potentially looking at taking here. So stop loss, we put our stop loss up here. Why would we put it there? It's comfortably protected behind this little high. It's protected behind the high of this candle. And we've already got this deceleration happening. So chances are from here, price may come up to here. That's okay. We're still within our stop loss. We don't lose any money until it hits stop. When it hits stop loss, it'll automatically close out your position for a 1% loss. We want to preset all of these things. So once we enter the trade, we go to the beach, we go enjoy our lives, we go for a swim in the swimming pool out here, or sunbathe, whatever it is that you're into. We're always having a stop loss, always having a profit target and an entry price. So this notion that traders, even day traders, spend 8, 10, 12 hours a day on the charts, that's not the case. It doesn't really happen. Some people do, but they're just simply over trading. There's not that many opportunities in the market for them to be doing that. Fundamental, or when you think of a trading floor, this is more fundamental traders, and they're reading the news and they're watching the things. Most of what they are doing is research. They're not sitting there on the charts trading all day. They're watching the news and doing all that stuff, which I don't do any of. I don't care. That's what fundamentals are. Technical analysis is pure chart patterns. But again, I don't want to get ahead of myself. Let's get back to it. So this is the trade. I quite like that, right? So let's say that, cool, we're going short here and we're trading down to recent lows. I sincerely have no idea what happens next. I haven't fast forwarded this chart. I just went to a random date and just cut it. So I don't know if this is going to be a winner or a loser, but that's besides the point, right? So now that we're in, and let's just say that we have a 100K account, right? So let's just say we have balance is $100,000 at the start of the trade. Balance is 100,000. So that means that we're risking how much? Hopefully you said it. Obviously I can't hear you. So we're risking 1,000, oopsie daisy, here we go, $1,000 on this one trade. So if it hits stop loss, we will lose $1,000, right? And that maybe sounds like a lot to you. It's 1%. So whatever your account balance is, it's that minus 1% if it runs and hits our stop loss. Now, if it hits our profit target, we will make $3,240 minus a little bit of commission to our broker. So it'll be maybe $3,200, right? So let's see what happens. Next candle. Okay, cool. So we're running in profit now. It's quite nice. That ran into, I've got a bit of trade management. So we didn't quite get to 1% profit on that candle. So let's carry on. When it gets to 1% profit, I remove all risk by moving my stop loss to my entry price. It's just part of my trade management. So let's see what happens. Oh, brilliant. Okay, so we are, okay. This is almost working out a little too well. I didn't expect it to be such a great position. It makes me look like I went back and actually pre-looked at this. I swear I didn't, right? Anyway, so now we're over 1% profit. We actually made it to what is about 1.22 running profit. So we're in at $1,220 running profit. Ultimate profit target is down here. So I would go ahead and move my stop. I still keep my position sized up like this because I like to see my original stuff. I'd be moving it about here. So I like to trail up, give it a bit of breathing room. So now we've secured about 0.2% profit, something like that, which is about $200. So let's carry on. Okay, this is almost a little bit, this doesn't always play out like this. This is pretty good. So now we trail this down a little bit more, maybe remove half the profit. So we're at over, or like we've secured this much profit. So if price pulls back now, we would have still banked 1.15%, but it has run all the way down to 2.6. At this point, because it ran so close to our profit target, I've got another method that I like to remove secure profit as I get tighter. But in this case, let's just stick with this. Let's see what the next candle did. Okay, so that actually ran up and hit our stop loss now, right? So we didn't get our full 3.24. Maybe it could have kept going down, hit our full 3.24. The total profit that we did run into was 2,670 or 2.67%. And then it stopped us out for 1.16, 1.17. So that's how we just made $1,000 on that. And that only played out, that position played out from 1, 2, 3, in about 4 hours. I take between 8 to 12 trades per month, right? And that's across 4 different strategies that I trade. 8 to 12 per month. And I rarely, if ever, spend more than 3 hours a day on the actual charts. Like, man, I've got a life to live. I'm here in Bali. I don't want to be spending all day on front of screens, right? And also, I spend a lot of time building the pro trader community, helping support you guys, filming videos like this. So that's how a trade looks, right? Those 3 elements: stop loss, profit target. This little number here, this 1.17. That's not a percentage. That's a reward risk ratio. So that's why we always do, because we're always doing a 1% risk per trade, then we just know that it's easy 1-to-1, right? If this was 2%, or if we were for some reason risking 2% on that trade, we'd be risking $2,000. And this here, 1.16 RR, or reward risk, it's the reward risk ratio, it would be, we would have made 2,300 or thereabouts. But that's called over leveraging. When you start out, never trade more than, never risk more than 1%. You can risk less. You can risk 0.5. You can risk 0.25. If we're risking 0.5, then we're risking $500 on our 100K account to make about $600 or thereabouts. So that's how a trade looks. I hope that makes sense. Now, when we jump down to a lower time frame, right? So this is the 1 hour time frame. Now, if we want to jump down to the 15-minute time frame, this is kind of more scalper territory, right? We could be putting our stop loss behind that there. Maybe we entered after this high test candle here. So we'll see how we're tightening up the stop loss now. He's a little bit narrower. And maybe we targeted only to these highs here, like these wicks, because we can see price is bouncing off a certain level. Now this position here played out in, how much was this? It's more candles we see on the screen here, but let's say that it was 12.15 and then to 2:45. So that one there was only 2 hours, 2.5 hours. Now, and it was much tighter. Now you could go all the way down to the 5 minute. Right? Now this is very much scalping territory. And you can be down here. You could even go down to, let's just for entertainment's sake, let's go down to the 1 minute. And you can get very, 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 very microscopic here, right? Some people might be looking at taking a trade like this. Now, the thing is, when you get down to these lower time frames, there's a lot more noise and it becomes a lot less reliable. There's a lot more random. But let's say that you had taken this. Like, look, this is still a 2.13% or RR. And that one only played out from, like, look, that was 12.27 through to 12.47. So that was 12.27, 12.47, yeah. So it was, or 44, whatever it was. So that was only like a 20-minute position, right? I don't encourage that. I don't condone that. The rules, same rules don't apply on those lower time frames, and you'll end up losing money. And plus, you got spreads as well. So you're paying astronomical fees because your actual position size, your lot size, is much bigger because you're risking so much more on a much smaller move, right? So now looking at this chart, the same rules apply to all to crypto, to FX, to commodities, all of that stuff, right? Now, because we've got this RR kind of reward risk ratio concept, looking at this chart here, let's go back to our 1 hour. All right, well, that's actually looking pretty similar, right, as that last one. So looking at this, what do we see here? Pretty much same shit, right? Same stuff. If we go back to, well, let's go to the daily. So, whoops. Look, how different does this look to something like, to either the previous chart, or how different does this look to, looks pretty much the same, right? Pretty much, well, there's a few little gaps in here. Ignore the gapping. That's just where the market closes. This is obviously stocks. Well, this is Apple shares. So going back through those, this is Apple. Ignore that. Yeah, we do have some gaps in here. That's just because it's not a perfect 24 hours a day market. So sometimes it opens a bit lower or closes. So this here opens higher or opens lower than the close. So the close here and then it opened up here. But if we go back to this one here is gold, right? Pretty much the same. This one here is Bitcoin, pretty much the same. And this one here is the Australian dollar, US dollar. There's nothing that different about those charts. It's all just raw price action pattern. And this brings me on to my final point here, which is, so we've covered reward risk ratio, right? How it doesn't matter how big the move is. We'll use one analogy. I love analogies, right? Basically, what the reward risk ratio is us betting. Let's say that you and I wanted to have a snail race, like I used to do back in New Zealand when we were kids, right? We'd draw a circle, and then we'd go spend half an hour trying to find the meanest, greenest, biggest looking snails we can find in the garden, right? Then we'd put these snails. We'd have a small circle in the middle, and then a big circle on the outside. We'd all put our snails in the middle circle, and then bet whose snail is going to make it to the outside ring first, right? Now, let's say that again, we're all bringing it back to trading, right? We were all going to bet 1% of what we had in our wallet on that, right? But we can only win 1% of what's in our wallet, or let's say 10%. Let's say that I've got $100 in there and I'm putting $10 on this position. I certainly didn't have $100 when I was a kid in my wallet. Definitely not. So the distance of that outside circle doesn't matter really, right? Like if there's the circle in the middle, if we started here, the snails start here, and then there's the circle out here, and I've got $10 on there, and I'm wagering $10, I'm going to win $10, or I'm going to lose $10 because my buddy's going to beat me. It's exactly the same as if we drew the circle out here. He's got a snail, I've got a snail, I've got $10 on it. If it makes it to here, I'm going to make $10. If it doesn't make it to there and his beats me, or he's going to make $10, I'm going to lose $10. If the circle's here, right? $10. It's the same thing. That's what leverage is, right? Leverage just brings the circle a little bit closer because we don't want to wait months for something to go. Now, what I hear from novice traders, sometimes who are more intrigued by the crypto market, is there's more opportunity, there's more vol. Look at how much the market moves, and it's like it really doesn't matter. Like all you're saying is the yeah, you're not really saying anything. It could be when you're looking at the forex market. If you zoom out, sure, and if you looked at it from a dollar figure, from a ticker point of view, it'll look very flat. Let's have a look, right? If you were to, this is how. Actually, let's clean up this chart a little bit. This here is how crypto traders think forex looks, right? Where they think that a crypto chart looks like this. So it looks like there's more opportunity. If you get in here and you sell up here, wow, look at how much money you just made, right? But as you've just learned now, it is exactly the same thing as if you were to, let's go back to our position sizer. If you entered like here, and you put it like this, it's still a 1-to-1, like with the reward risk ratio, you're still risking 1%. So if you were to manage to catch that perfect run there and you made 3.5%, and they're imagining it like this because it's crypto and you got in here and you're like, oh, wow, look at this, such a great big move. It doesn't matter. Like, it could also look like this. What really matters is simply that ratio. So again, it's the size of the circle, and you can choose how big that size of the circle is by choosing which time frame you're trading. Make sense? So finally, technical versus fundamental analysis. Like I said, I'm trying to condense as much into these as possible. Technical versus fundamental analysis. Technical analysis is the craft of analyzing and trading specifically raw price action. It's incorporating things like the 6 core principles, which we're going to cover, which is your support resistance, your market phase, your market condition, indicators, price action patterns, and candlestick patterns. Those are your 6 core principles. Now, fundamental traders consider what's going on the global macroeconomic stage. Who's the next president in the running? What are the financial statements that Apple just released? Or what are the interest rates of the Bank of England? Are they going to be putting them up? Are they going to be putting them down, right? Is there a war? Is there global tensions? What are the trade tariffs? What's happening here, right? And there is so much overwhelm. There's so many things there that you can be studying, and this is where you can really, really dedicate your life to this stuff. It's something, if that's something that you're into and you love all of that, go for it. Incorporate fundamental analysis into your trading. I have no interest in that. Fundamentals, I like to think, is almost like a popularity contest, right? I'm a little bit of a hermit, I'll be honest with you. I've got my 5 friends and I like to go on adventures, and like I said, I like to have a life. I don't want that life following news. My girlfriend already gives me a hard time how little I follow and like her pictures on Instagram because I'm bloody never on it, right? I'm the last to hear about these things, and partly by design. I don't check the news. I don't go on I don't follow that at all. So if you've got this idea or this notion that you need to be having CNN Money or Yahoo Finance, these guys just streaming news at you 24 hours a day, not the case at all, unless you're into fundamentals, right? Now, the different asset classes, fundamental, if you're trading stocks, so equities, Apple, Microsoft, things like that, that's generally where fundamental traders prefer to spend their time trading. They prefer to trade shares in the stock market, right? Not that it's because there's more money in there. There's certainly not. If anything, there's less money. Whereas stock market, the US stock market, it's about a $300 billion trading volume per day, right? Crypto, I think, is like 5. Forex is the largest, which is about 10 trillion per day. Significantly larger than any other asset class out there. So I like Forex. It means that the raw price action pattern can't be manipulated by some guy tweeting on, a tweet or the Reddit users posted some crap that, again, I'm last to the party to hear about this stuff. I just don't care. So if you like fundamentals and you like to read financial statements, and if you're beginning trading, don't bloody start with that, because that's a whole thing in itself. But this is where you're checking who's what's Apple's new product doing? How's it solving this problem? Is it going to be outperforming the competitors? You're going to know what the competitors are up to. You're going to know what the management are doing, right? Who's got a lawsuit because they got caught, I don't know, doing shady things, fondling the intern. The company's price is going to respond to their stock price is going to respond if somebody's under investigation in that company. There's so many different things. It's just not really worth it. The ones that I do follow are sometimes occasionally bank interest rates, and I just find when there is major news that is going to happen that could affect a currency or a company, and I don't trade it. So versus fundamental traders who are trying to catch and predict and get in, and they want to see news announcements so that they can trade it. If there's something like that, I just stay away. I give it a wide berth and just wait till the markets are cool and calm and everything's all good, all peachy. And it's just the technical traders that are driving the market from there. So that's the difference. What have we covered here? We've covered chart action, price action pattern, a chart. What is all of that? We've covered the basics of a trade, how that looks, exactly what the stop loss, the profit target, entry price, all of that. Not exactly, it's not a strategy. We're going to cover the strategy next. We've covered exactly how money is made, what the reward risk ratios are, how we manage risk, how we can make profit, of course. And then, of course, finally, we've just covered the technical and fundamental analysis. What's the difference there? And also how I much prefer and why I prefer technical analysis. And that's primarily what Pro Trader teaches. So if you're one that prefers this, what we've just covered here, everything that we've covered, apart from just that little explanation, is all technical analysis. Cool. I hope that's valuable. I know there's a chunky lesson. Maybe go back and review it a couple of times before moving on to the next module. If you feel you've grasped at least, let's say 70% or 60 to 70% of this, like more than half, you're probably ready to jump into the next module. So I'll see you there. Cheers. Bye for now.